a massive beat across the board for ExxonMobil this morning. Adjusted earnings per share came in at $3.52, easily clearing consensus estimates. We're looking at $14.7 billion in adjusted earnings for the second quarter of 2026. Cash flow from operations hit a staggering $23.6 billion. And in terms of forward guidance, management remains absolutely locked in on their 2030 growth targets, signaling some really aggressive production increases.
Yeah, and the market is reacting exactly how you'd expect.
Right, the stock is catching a solid bid in early trading. I mean, largely because they also declared a third quarter dividend of $1.03 per share. It just proves their cash engine is completely unfazed by recent global volatility.
It is a powerhouse print. I mean, for retail investors or analysts trying to model the energy sector today, these headline numbers from the Q2 release are just, they're essential reading.
Yeah.
But to really understand the stock's trajectory, we have to look past that top line beat. We have to dissect the actual machinery here. Management is really hammering three core themes: an advantaged portfolio, deep structural integration, and a pretty ruthless approach to cost savings.
Right, because generating almost $15 billion in a single 90-day period doesn't happen by accident, especially right now. I mean, imagine your company takes a nearly billion-dollar hit because a geopolitical conflict chokes off a key supply route.
Most corporate boards would be in full panic mode.
Exactly. They'd be issuing profit warnings. But ExxonMobil just absorbed that, shrugged, handed $9.4 billion back to its shareholders in a single quarter, and posted its best production numbers in 2 decades.
Yeah, it's wild.
So our mission for this deep dive is to open up their Q2 ledger, translate the heavy corporate terminology, and figure out how they built this bulletproof financial machine. Let's start with the accounting reality versus the operating reality. The release highlights $14.5 billion in GAAP earnings, but it heavily emphasizes that $14.7 billion in adjusted earnings. Why the focus on the adjusted figure?
That's a really crucial distinction for anyone reading an earnings report. So GAAP generally accepted accounting principles, that's the strict legal standard. It includes absolutely everything.
Like one-time write-downs.
Right, one-time paper losses, accounting shifts, things that don't actually impact the day-to-day cash business. Adjusted earnings strip out those one-off anomalies. By pointing Wall Street to that $14.7 billion figure, Exxon is essentially saying, if you want to know how much money our core business actually made this quarter, look at this number.
Got it.
And, that number is supported by $17.2 billion in pure free cash flow. That's the cash left over after paying all the operating bills and the capital expenditures.
It totally explains how they were able to return that $9.4 billion to shareholders. I mean, $4.3 billion in dividends, $5.1 billion in share repurchases. They aren't borrowing money to do that.
No, not at all.
They're funding it directly from the cash they generate. There's actually a specific quote from CEO Darren Woods in the release that stands out. He said this quarter was, quote, shaped by disruption, but defined by execution. He noted they aren't built for one market condition, but to lead as markets evolve.
Yeah, that quote is basically the thesis statement for their entire capital strategy, because in a commodity business, your revenue is traditionally at the absolute mercy of the macro environment.
Right. Crude spikes, you look like a genius. Crude crashes, you hemorrhage cash.
Exactly. Yeah. What this earnings release is signaling is that Exxon has effectively decoupled itself from that boom and bust cycle. They've built this cash-generating engine that functions regardless of which way the geopolitical wind is blowing.
I'm trying to visualize this structural resilience. Is it accurate to think of Exxon less like a high-speed sports car that gets destroyed by a single pothole and more like a heavy-duty industrial off-road vehicle?
I like that.
Like they seem engineered with these massive financial shock absorbers, so they hit macroeconomic craters and the passengers don't even feel a bump.
The off-road vehicle analogy totally works, but only if you recognize that they are constantly upgrading the suspension while driving.
Right.
The numbers in this Q2 report prove that their specific strategy of insulating the balance sheet is actually working. The ultimate proof is that Q3 dividend of $1.803 per share.
Because you don't commit to that unless you're sure.
Exactly. In corporate finance, you don't declare a forward-looking payout of that size unless your internal models show absolute certainty that your cash flow can support it, even if oil prices suddenly drop next month. It's a massive signal of confidence to institutional buyers.
So if financial strategy is the vehicle suspension, The upstream operations physically pulling hydrocarbons out of the ground, that's the engine. Let's look at where this cash physically came from. The upstream segment posted adjusted earnings of $9.189 billion.
Huge number.
Yeah, it's a massive sequential jump from the first quarter, which was at $6.265 billion. And the sources note this represents their highest production in more than 2 decades, specifically excluding the Middle East disruptions.
Yeah, hitting a multi-decade production high for a supermajor of this size is a phenomenal logistical achievement. Now, part of that quarter-over-quarter leap was just the absence of operational disruptions in Kazakhstan.
Oh, right. That depressed their Q1 numbers.
Exactly. So when those fields came back fully online, it provided a nice mechanical bump. But the real narrative, the core of that engine you mentioned, it's entirely driven by the Americas.
You're talking about the Permian Basin in the U.S. and the offshore operations in Guyana.
That's the spot.
The stats here are wild. The Permian hit record production of 1.8 million oil equivalent barrels per day, and they're projecting a 9% compound annual growth rate through 2030 for that basin.
Yeah.
They explicitly point out this growth rate outpaces all of their competitors.
It's massive.
And then, down in Guyana, their 5th FPSO vessel, a floating production storage and offloading vessel, just set sail. On track for a Q4 2026 startup, adding another 250,000 barrels a day. With the entire globe to drill in, why is Exxon treating these 2 very specific spots as the twin pillars of their future?
To understand that, you have to look at what the industry calls advantaged volumes. For you as a retail investor, it's vital to know that not all barrels of oil are created equal.
Right.
Pumping a barrel in the North Sea has a vastly different profit margin than pumping one in Texas. The Permian and Guyana represent the absolute pinnacle of economics in Exxon's portfolio. You have an incredibly low cost of supply, meaning they make a profit even if global prices plummet.
Wow.
Plus, you have reliable legal jurisdictions, which just removes a massive layer of risk. But to truly understand how lucrative this is, we need to look at a highly specific piece of forward guidance management gave regarding Guyana.
Yes, I wanted to ask about this because it sounds like super dense accounting jargon. The guidance notes that in Q3, Exxon's net entitlement at Guyana is expected to decrease by roughly 100,000 barrels per day due to the, quote, desaturation of the cost bank.
Yeah, it's a mouthful.
If production is booming, why is their entitlement dropping, and what on earth is a cost bank?
This is actually a fascinating look at how international energy contracts work in the real world. So when Exxon goes to a partner country like Guyana to build a deepwater offshore operation, Exxon fronts all the money, billions of dollars in capital risk.
Because the host country doesn't want to pay for the rig up front.
Exactly. So because Exxon takes all the upfront risk, the production sharing contract usually stipulates that in the early years of pumping, Exxon gets to keep a heavily outsized percentage of the barrels produced. That oversized share is the cost bank.
Okay.
It's the oil they sell to reimburse themselves for building the rig in the first place.
Ah, so the cost bank is basically the mortgage on the offshore rig.
Exactly that. And what this Q3 guidance about desaturation means is that Exxon has fully recovered its initial capital costs for certain phases of that Guyana project. The mortgage is paid off.
Oh, wow. So because the initial debt is cleared, the profit-sharing ratio shifts. The host country gets a larger cut of the physical oil, which is why Exxon's volume drops by 100,000 barrels, but their actual profit margin on the barrels they do keep goes up.
You've got it. On paper, it looks like Exxon is losing 100,000 barrels a day of volume, but financially, the project has crossed the threshold into its pure profit-generating phase. The capex is recouped. It's a massive milestone that signals this asset is maturing into a long-term cash cow.
Okay, that makes complete sense of the guidance now. But let's follow the molecule here. You can pull 1.8 million barrels out of the Permian, but raw crude is practically useless to a consumer.
Right.
If you can't process it efficiently, a dip in global crude prices will still hurt you.
Yeah.
So let's look at the downstream side, energy and chemical products, to see how they protect those massive upstream investments.
This brings us to the second major theme of the report integration. Wall Street analysts often prefer pure-play companies. You know, a company that only drills or a company that only refines.
Is it simpler for their financial models?
Exactly. But Exxon's philosophy is total integration across the entire life cycle of the hydrocarbon.
Let's break down the segment numbers to see that in action. Energy products reported $4.099 billion in adjusted earnings. They cite record second quarter diesel production and highly efficient utilization of their U.S. Gulf Coast refineries.
Yeah, even with scheduled maintenance bringing base volumes down.
Right. Then chemical products posted $1.324 billion. The earnings release heavily attributes this to a North American feed advantage. Can you translate that? What physical advantage do they actually have on the ground?
It all comes down to natural gas. Chemical plants require immense amounts of energy to run, and they use natural gas liquids as the literal raw material, the feedstock, to create plastics and advanced materials.
Okay.
Because the U.S. has an absolute abundance of cheap natural gas compared to Europe or Asia, Exxon's North American chemical plants cost a fraction to operate compared to their overseas competitors. They're taking a cheap, abundant local resource and turning it into high-margin global products.
Which leads right into this specialty products segment, which brought in $1.62 billion. The report credits higher base stock margins, which I assume means the base oils for industrial lubricants.
Correct.
But they also announced a final investment decision, an FID, for a 120 kilotons per annum Proxima blending expansion in Louisiana. Again, heavy corporate speak. What is a 120 KTA Proxima expansion, and why does a retail investor care?
An FID simply means they've officially approved the budget and are breaking ground. Proxima is Exxon's proprietary brand of advanced thermoset resins.
Resins.
Yeah. Basically, high-tech materials used in everything from construction to automotive manufacturing because they're lighter and stronger than traditional alternatives. Kilotons per annum is just how much they'll produce.
Right, the metric.
Why it matters to an investor is that this isn't just selling a barrel of oil. This is taking a raw commodity and chemically engineering it into a highly specialized, incredibly high-margin product.
I'm trying to wrap my head around how this all connects. Is it essentially a farm-to-table business model, but for hydrocarbons?
What do you mean?
Like, imagine a company that owns the farmland where the wheat is grown, owns the trucks that transport it, and owns the Michelin star restaurant that bakes it into a $50 pastry.
Oh, I see.
If the wholesale price of raw wheat fluctuates on the open market, it doesn't devastate their business because they just capture the profit margin at the restaurant level instead.
The farm-to-table analogy is a great way to visualize it. Exxon is creating a self-hedging ecosystem. When crude prices are high, their upstream drilling segment prints money.
Right.
But let's say crude prices crash. The upstream profits shrink, but suddenly they're refineries and chemical plants. The Michelin star restaurants, in your analogy, they're getting their raw ingredients for dirt cheap. Their profit margins in downstream explode. They are uniquely positioned to capture the margin at every single step of the value chain.
It's all about keeping the profit inside the house. Which leads to a crucial pivot here. Generating revenue across the value chain is impressive, but corporate bloat can destroy those margins instantly. We need to talk about how Exxon keeps the money it makes, cost savings, and capital allocation.
For long-term investors, this is the most critical part of the earnings report. You can have the best assets in the world, but if your corporate overhead is bloated, the shareholder never sees the returns.
And Exxon is making some aggressive claims here. They reported $16.3 billion in cumulative structural cost savings compared to 2019. The presentation explicitly notes this is more than all other independent oil companies combined.
It's a staggering number.
But meanwhile, their year-to-date cash capex is sitting at $13.0 billion. And looking ahead, their 2026 planned investments are actually 20% higher than their nearest competitor.
Right.
They claim this sets them up for their 2030 plan, projecting a massive $25 billion in earnings growth and $35 billion in cash flow growth. But I have to push back on this narrative. It feels like a glaring contradiction.
How so?
How can management brag about being the ultimate penny pinchers who saved $16 billion while in the very next breath admitting they're outspending their closest rival by 20%? Are they ruthlessly cutting costs, or are they going on a massive spending spree?
It looks like a paradox on paper, I'll give you that.
Okay.
But it's actually the definition of elite capital discipline.
Yeah.
To understand it, you have to separate corporate spending into two distinct buckets.
Okay.
Structural bloat and advantage asset investment. Structural bloat is bad spending. For a supermajor like Exxon, that looks like redundant middle management, duplicate IT systems across global branches, inefficient supply chains.
The fact.
Exactly. And since 2019, they have been ruthlessly tearing that bloat out of the company, literally recovering $16.3 billion of wasted motion.
So they're plugging the leaks in the hole.
Yes. And once the leaks are plugged, you look at the second bucket, advantaged asset investment. That's the CapEx. That is good spending. They're taking those billions they saved from cutting administrative fat and aggressively pouring it into the Permian and Guyana.
Oh, I see.
They aren't spending 20% more just for the sake of being the biggest spender. They're spending it because they've mathematically proven that every dollar put into a Guyana drill ship yields a massive return. It's a disciplined reallocation of capital away from low-return overhead directly into high-return production.
Okay, that clarifies it. They aren't just hoarding the savings. They're recycling it into the highest yield engines they have. And when you're compounding returns on a $13 billion CapEx budget, that's how you arrive at those staggering 2030 projections.
Precisely. The cost savings fund the growth, and the integration protects the margins.
All right, so we've built up the bull case here, analyzing their internal execution. But an earnings report is also about forward-looking risk. Let's shift from their controlled internal environment to the chaotic external risks they face, particularly geopolitical instability.
Yeah, and this is where we see how transparent management is willing to be with the street. The modeling toolkit accompanying the earnings release doesn't hide the external drags on the portfolio. It highlights them.
The sources repeatedly cite Middle East disruptions as a tangible drag on earnings. The numbers are specific. It cost them $194 million in Q2 alone and $900 million year to date.
Which is not small change.
Right. But it's the forward guidance on worst-case scenarios that grab my attention. They model out a scenario where if the Strait of Hormuz were to experience a closure for the entire third quarter, it would reduce Exxon's Middle East production by roughly 750,000 oil-equivalent barrels per day versus 2025 levels.
Right.
And they also provide a raw look at their earnings sensitivities. They note that a $1 per barrel increase in Brent crude equals a $700 million annual boost to their bottom line. A simple 10-cent increase in Henry Hub natural gas equals a $90 million swing.
It's incredible to see it broken down like that.
For anyone listening who feels the pinch at the gas pump when tensions rise in the Middle East, these numbers are staggering. But also it exposes a vulnerability, doesn't it?
Yeah.
For all of Exxon's fortress-like balance sheets, this math proves they are still fundamentally at the mercy of global flashpoints. If one single waterway closes and chokes off 750,000 barrels a day, how much control do they really have over that beautiful 2030 destiny they just projected?
That is the existential question for every global energy company. You can never eliminate geopolitical risk. You can only manage and mitigate it. What you're seeing in that sensitivities chart is Exxon's way of quantifying the unknown for Wall Street.
Right, giving them the math.
Exactly. During a crisis, markets panic because of uncertainty. Exxon is stepping in and saying, we cannot control the Strait of Hormuz, but if it closes, here is the exact mathematical formula of how it impacts us, and here is how our other assets will absorb the blow. They're giving analysts the tools to model the worst-case scenario, which actually calms institutional anxiety.
So they're essentially saying, yes, a Middle East disruption hurts, but it isn't fatal to the overall machine.
Exactly. And this connects everything we've talked about today. Why is Exxon aggressively pouring CapEx into the Permian and Guyana? Why the massive focus on the Americas?
It's the mitigation strategy?
Yes. It's not just about high yields. It is a calculated mitigation against these exact Middle Eastern risks. By shifting their center of gravity to U.S. onshore and South American offshore production, they are structurally reducing their long-term reliance on the most volatile regions in the world.
They're geographically diversifying their shock absorbers. Even when they take a $900 million hit in the Middle East, they have 1.8 million barrels a day pumping out of the Permian to compensate, allowing the overall machine to still generate that $14.7 billion in adjusted earnings.
It's a masterclass in risk management and capital allocation at a global scale.
It really is an incredible balancing act when you step back and look at the whole picture. To summarize the sheer scale of the mechanics we've unpacked today, we are looking at an energy titan that delivered $14.7 billion in adjusted earnings in a single quarter, significantly beating expectations.
Unbelievable quarter.
They achieve this through a philosophy of deep chemical and refining integration that hedges against crude volatility. They're pulling $16.3 billion in structural bloat out of their operations and instantly reallocating it, outspending rivals by 20% to build out their mega assets in Guyana and the Permian. And they're executing all of this while mathematically managing very real geopolitical disruptions.
Yeah.
For you, the listener, whether you're analyzing this stock for your portfolio or just watching global geopolitics unfold, examining an Exxon balance sheet is like looking at a high-definition, real-time reflection of the world's economic health.
It is the ultimate macroeconomic barometer. And, looking at all this data, I want to leave you with one final thought to ponder.
Go for it.
Given the massive, record-breaking investments coming exclusively out of the Permian Basin and Guyana, while Middle East disruptions are explicitly dragging down the ledger, are we witnessing a quiet, fundamental recentering of global energy power, away from its traditional hubs and firmly back into the Western Hemisphere. It's a profound strategic shift, hidden right there in the quarterly CapEx numbers, and it's something to watch closely as these capital flows compound over the next few years.
A geopolitical tectonic shift, written entirely in accounting disclosures. Absolutely fascinating. Remember, a single earnings report never tells the whole story, but it does show you exactly where a company is placing its biggest bets for the future. Keep questioning the mechanics behind the headline numbers, and be sure to follow the show for our daily earnings coverage to stay ahead of the curve. Thanks for joining us on this deep dive.